Good afternoon, everyone. Please welcome to the stage Opportunity Finance Network's Senior Vice President of Development Services, Sindhu Lakshmanan.
Good afternoon, everyone. I hope you've had a great morning of learning, discussion, and reconnecting with colleagues. Thank you for joining us for this afternoon's plenary. Over the next hour, we'll explore 3 conversations that highlight important dimensions of what it means to be a CDFI small business lender right now. At the heart of our work is helping entrepreneurs, businesses, and communities access the resources they need to thrive. Capital is a critical part of that equation, but many of us in this room know that lending is only part of the story. The real work often happens in relationships we build, the support we provide, the communities we serve, and the systems we create to make that work sustainable over time. During the following conversations, we'll explore 3 topics that sit at the intersection of impact, sustainability, and growth for CDFI small business lenders. From what it takes to support entrepreneurs and rural communities that have long been overlooked by traditional capital, to how technology is reshaping the way mission-driven lenders operate and serve borrowers, to how technical assistance helps turn financing into lasting business success. These conversations are designed to be practical, candid, and grounded in practitioner experience. We'll explore what's working, what's challenging, and what lessons we can learn from one another as our industry continues to evolve. With that, I'd like to welcome Joe Bateman, Daniel Wallace, and Russ Siegel to the stage for our first conversation on supporting rural America.
Good afternoon, everyone. It's a pleasure to be here. I always enjoy getting to come to the Small Business Finance Forum conference where we can continue to learn how to better support CDFIs and their lending to small businesses, and I always learn so much from being here. And at JPMorgan Chase, we're focused on helping businesses start, grow, and hire, and our relationships are key to making this happen. The firm works with organizations across the financial ecosystem to mobilize capital and resources to help businesses grow. And one way we do that is through CDFIs, who play a critical role in communities across the country. And JP Morgan works with CDFIs in many different capacities across the firm, providing everything from debt financing to philanthropic support to technical assistance. And over the past 2 decades, JPMorgan Chase has provided more than $2.4 billion in support for CDFIs as part of our broader commitment to community development and economic opportunity. Work that will continue to be scaled as part of our recently announced American Dream Initiative. JPMorgan Chase also partners with CDFIs lending in rural markets. And we've also recently increased this focus with our Heartland strategy, which seeks to increase the bank's presence in areas where we've historically had less presence. And a large focus of this is increasing our support of small businesses in these states. And CDFIs will be an important part of that push. We know that rural communities have unique needs and characteristics. So we've recognized that as part of this expansion, it's critical to partner with experts who have developed trusted relationships through their long track record in serving rural communities. So today, I'm glad to have the opportunity to ask some questions to 2 experts in lending in rural communities about how the industry can think more intentionally about rural as a distinct and critical market. So before I jump into the questions, I want to pass it to both you, Daniel, and you, Russ, to briefly introduce yourselves and your organizations, and at a high level, how you support rural small businesses.
Well, good afternoon, everyone. It's a pleasure to be here. My name is Daniel Wallace. I serve as the president and CEO of Appalachian Community Capital. We are a membership-based intermediary serving small business CDFIs from northern Mississippi all the way up to western New York. ACC has this regional approach serving portions of 13 states, but we're focused tightly on small business support, CDFI ecosystem development, and maintain a strong emphasis on rural.
And I'm Russ Siegel. I am the CEO of Sequoia Fund. We are a native CDFI located in Cherokee, North Carolina. I always say we're centrally located. We're halfway between New York and Miami. And so we're easy to find. We serve the eastern band of Cherokee Indians, but we also serve a large non-native population throughout western North Carolina. We do small business lending, we do housing rehab loans, small dollar loans, emergency loans, and also credit builder loans.
No, thank you both. It's quite the diverse array of geographies and borrowers that are in your portfolios. I'm going to start with a question for Daniel, and then Russ, I'd love to hear your follow-up on this as well. But what are rural small businesses facing right now that people might not fully appreciate?
Yeah, thank you, Joe. I think I'm going to focus my answer on one item in particular. Many rural entrepreneurs are facing far more than a capital gap. They're often facing infrastructure gaps. Depending on the community, that can mean limited access to financial services, broadband, workforce, childcare, affordable housing, transportation, or business support networks. But at the same time, many rural communities are seeing significant economic activity around energy, recreation, manufacturing, and technology infrastructure. So the challenge is making sure local businesses in rural places have access to the capital and support needed to participate in and benefit from that growth. Ultimately, we believe small business finance is community wealth building infrastructure.
Russ, anything you want to add to that?
Yeah, for years we talked about small rural communities and brain drain, right? We were losing young people to larger metropolitan areas who needed to go find their own way. And I think what we're seeing now, instead of brain drain, is we're seeing a population exchange that we've not really prepared for. And the population exchange is that, yes, those young people are still leaving college and going out to find their fortunes in larger cities. And the larger cities are seeing retirees, baby boomers, who are moving into the more rural areas because they're trying to get away from the rat race, right? They're trying to find a slower pace of life. And so what we're seeing is a demographic shift that instead of working with smaller, younger entrepreneurs, not smaller, but younger entrepreneurs, that we're working now with those next level entrepreneurs, those second act entrepreneurs, who may have experience somewhere else, but now they're bringing that to a small town or a rural area somewhere. The second thing is that having just been through Hurricane Helene in the last couple of years, we're realizing now that rural, we have a role to play in disasters. It's not confined just to Florida, the Gulf Coast, or Tornado Alley. That natural disasters can hit anywhere. I mean, we had back in 2018, a derecho in Iowa swept through Nebraska and Iowa. It's like an inland hurricane that people hadn't seen in generations. So, we're seeing some of those things that, quite frankly, we can't control as funders, but we have to be able to adapt to. And so in these changing circumstances, we look at our small businesses and say, now, how do we fit into what you need?
Yeah, and thank you for that. I wanted to ask also about, a lot of times, as you have alluded to, the borrowers and your clients are spread out much more than they might be in an urban context. And so how do you think about pipeline building and client engagement when your borrowers are spread across hundreds of miles? Russ, I'll start with you on that one.
It really means a lot more time out of the office. We can't be behind our desks. We've got to be at Chamber of Commerce meetings. We've got to be at the schools, and we spend a lot of time in the middle schools and high schools talking about financial literacy, talking about entrepreneurship as a career path, and helping these young people understand that being in business for yourself is a career choice, and you can do that, and those are a set of teachable and learnable skills. We have to show up at town council meetings. We have to be out of the office, meeting people and building that trust, because if they don't see us in the communities, we talk about rural, and rural is not monolithic. Sometimes in our neck of the woods, we talk about mountain culture, which is very different. It's not as trusting, and if people don't see you at these places, they're not going to trust you. If they don't trust you, they're not coming to you for a loan, they're not coming to you for advice, and so forth.
Thank you, Russ. Daniel.
Yeah, just very briefly, because my response resonates. I would say that rural pipeline development is fundamentally relationship-based. So when you're looking at rural places or you're looking at rural expansion, you're not necessarily looking at a geography challenge. You're looking at a relationship challenge. So that means working through, in addition to showing up, that means working through trusted local organizations, community leaders, chambers, economic development entities, lenders, and nonprofit partners who understand the local realities. Technology can help expand reach and improve coordination, but trust remains the foundation. So from our perspective, this is where a place-led and networked for scale approach becomes important. Local leadership remains local, while knowledge, capital, and resources move through larger networks.
Yeah, thanks for that. And yeah, it definitely makes sense that if this is such a relationship-driven approach and the borrowers are spread over such a large market that you can't spend time behind your desk and you have to get out and be building those relationships, which I'm sure is also difficult with proportionately fewer resources. So what do you wish lenders and investors would better understand about what it takes to serve rural communities? And are your capital needs different than an urban-focused CDFI? Either one. Yeah, Daniel, we'll start with you. Daniel, we'll start with you, and then we'll go to Russ.
In slight contradiction to what we just said, the biggest misconception, I think, is that rural lending is simply urban lending with more windshield time.
Yeah. Yeah.
And you know, the second, Russ already mentioned it, is that rural is a monoculture rather than a vast diversity of people and places. So the work is, in fact, far more distributed, more relational, and requires a great deal of flexibility. And in many communities, the CDFI is not simply a lender. It is also a connector, convener, navigator, trusted local partner. Relationships are not a soft add-on in rural development. They are the delivery system. A handshake and the ability to look someone in the eye goes a long, long way. I think I would also say a couple more things. The scale of the rural opportunity, I think, is much bigger than many people appreciate. Rural America represents most of the country's land base, a major share of national GDP, a higher proportion of small businesses and small business employment, and is central to energy and food production, climate resilience, recreation, manufacturing, and primary location of infrastructure like solar, wind, and data centers. The opportunity is significant. And finally, rural is not a deficit story. In addition to what I just mentioned, rural communities have leadership, dedicated entrepreneurs, cultural strength, and strong local identity. The job of CDFIs is to help convert those assets into durable local wealth. That requires actually an abundance mindset, seeing not only what the communities lack, but what they are ready to build if capital and capacity are structured correctly.
Thanks for that, Daniel. Yeah.
Bravo.
Anything to add to that, Russ?
I think one of the misconceptions is that rural equals agriculture and that we are just one prolonged version of Footloose. You know, we're all out there. We're not out there playing chicken with tractors. We're not all out there playing chicken with tractors. And but yeah, a lot of people equate rural with agriculture, but in a lot of situations, we are providing the infrastructure for the places you like to vacation. You know, we're providing upgrades to the hotels, working capital to the restaurants. We're providing new build-outs for dental offices and professional practices. So all the things that happen in larger metropolitan areas happen in rural. They just, again, happen at a different scale, like Daniel said. And for us, distance equals cost. If you're in a highly populated area, it doesn't take a lot to put a line outside your door and around the block. But for us, having to go to people or having people come to us, we have people who will drive an hour and a half to us before they'll pick up the phone and call and see if we're even in the office. And that's just the way things work. I've got one guy who calls me every day when I'm on vacation. Where's Russ? You know, he's on vacation Tuesday. Where's Russ? He comes in the next week. He goes, I was by here 4 times last week. But that's what we have to deal with. And again, those relationships, I try to encourage them to pick up the phone. Doesn't always work. So our time horizons are longer, involved with that distance. You know, we can't just turn a loan around as fast as we could in a more populated area. You know, we have to drive farther to inspect collateral, to look at a piece of land. Takes longer to get surveys and appraisals, things like that. So yeah, I mean, it's just a different scale. It's a different pace.
That's helpful. Thank you for sharing that. And Daniel, I know JP Morgan Chase has supported your Powering Resilient Opportunities Fund, the PRO Fund. Can you tell us about how that fits into this picture?
Sure. Just in brief, the PRO Fund is a participation fund aimed at enhancing the capacity of ACC's members to deliver capital at scale in their communities. The PRO Fund essentially reflects a recognition that with rural communities being central to the nation's economic future, they're still frequently underserved by traditional capital flows. So our goal with this structured fund, with this participation fund, is not simply to move more money into rural places. It's also to strengthen the capacity of rural-focused CDFIs and ensure the communities have the tools and flexible capital needed to build long-term prosperity. Our goal ultimately is greater resilience, stronger local ownership, and more community wealth creation.
Thanks, Daniel. So I know that now everybody in the room is sold and ready to start rural lending programs if they haven't already. So as CDFIs are considering expanding into rural markets, what's something that you've learned that you would want to share about what it takes to get lending in rural communities right? I know that you've already shared some things about relationships are key, and FaceTime is important. And what are some other things, or maybe even just double down on that, about what other CDFIs can make sure to keep in mind?
You have to be there. We see folks across North Carolina who I run into them at meetings and they say, oh, we love Sequoia Fund. We love what you guys are doing over there. I've been there 20 years. I have never seen you. I don't know who you are. I've never seen your work in our community. And again, it's part of that pipeline building, it's part of that trust building. But character plays a big role, not just in the lending, but in the partnerships. We've got to be able to trust each other. And you've got to be willing to do things that you may not be tasked with in other areas. You know, we made a loan to a floral shop a month before Valentine's Day. Our entire office closed down. We delivered flowers for a day. And that's just being a good neighbor. Not just a good lender, but being a good neighbor. You got to show up and do those things. We've helped people clean out locations because they're moving across town. Again, good opportunity to close the doors and put on a t-shirt and to do some stuff. But you got to keep it simple. You got to reduce friction. Anything that gets in the way of helping people get to yes is going to make them back away. There was an earlier segment today where we were talking about, you know, people were not applying for loans because they thought for whatever reason they were not going to be eligible. We've got to reduce friction.
I guess, yeah. Just doubling down on that, what are some ways that you can reduce friction in the underwriting process to build that trust?
We've closed loans in the parking lot. We've gone to people's homes. We love technology. We desperately want people to use technology, and we still will print out an application and drop it off at their house, or we'll meet them at the grocery store with a paper application. Because whatever is easiest for them is what we're going to do. We have tried our darndest to move communication to official channels, and yet we still have people who will send our commercial loan officer or our consumer loan officer a Facebook message Or they'll run into one of them at the grocery store on a Sunday afternoon and say, "Can you tell me what my balance is?" Yeah. Sometimes we can. So again, we've got to meet people where they are, because that's what we do. As rural lenders, the main thing is we've got to look for friction. We have to examine ourselves, and we have to say, are we creating a stumbling block for people that is for our comfort and our convenience, but it's a problem for them?
Yeah, thank you, Russ. And we have about 20 more seconds, Daniel. You have it, yeah. And then we're getting kicked off the stage.
I'll just underline some of the things that I've already said. Successful rural expansion is place-led. It starts with listening, understanding local assets, and working through existing relationships. Scale comes through networks, collaboration, and shared learning, not through imposing a one-size-fits-all model. And I would contend that the future is not isolated communities competing for resources. It's place-led communities connected through networks that allow local leadership to remain local while solutions scale.
Thank you, Daniel. Thank you, Russ. This is great.
Please welcome to the stage Opportunity Finance Network's Senior Vice President of Credit Risk and Portfolio Management, Khaled Sarori, and our panelists.
Have a seat. Good afternoon, everyone. Khaled Sarwari, Senior Vice President of Credit Risk and Portfolio Management at OFN. And I'm pleased to be joined by Alexis Dishman from CRF and Sachi Shenoy from PCV. So AI and technology have been one of the most discussed topics in our conferences over the last 2 years. And as we all know, some CDFIs have already using and utilized these tools in many meaningful ways. But still, there are some CDFIs who are still trying to determine to see what makes sense for the organizations. At the same time, CDFI industry have always been built on trust, knowledge, human judgment, and relationship. As technology and AI evolves and reshape the financial services landscape, many of us in this room asking how these tools can support us and strengthen the work that we do while remaining true to our mission. So today, we're going to have a practical conversation on what's working for us, what concerns us, and how AI and technology may shape the future of CDFI lending and community lending. So with that, let's get started. And before I begin, I would like to give each of our panelists a chance to briefly introduce themselves. Alexis, can we start with yourself?
Sure. Good afternoon. My name is Alexis Dishman, and as mentioned, I'm the Chief Lending Officer at Community Reinvestment Fund USA. Community Reinvestment Fund, also known as CRF, is a national CDFI with a mission to expand economic opportunity. CRF serves as an intermediary to get our partners, small businesses, banks, public sector, government, foundations, and capital and technology and service solutions that transform communities. Since 1988, CRF has helped distribute over $4 billion in funding to transform local economies. And we do this through our direct lending, our 3 tech platforms, and our strategic partnership development.
Great, Sachi.
Thank you, Khaled. I'm Sachi Shenoy. I am PCV's Chief Data Officer. And PCV, or Pacific Community Ventures, is headquartered in Oakland, California. We are nearly 30 years old, and we really specialize in small business lending in the state of California. but we also pair small business loans with one-to-one pro bono business advisory support. And that is a program that we run nationwide, having served over 4,000 entrepreneurs and small business owners. We also have a Good Jobs Innovation Lab, which is one of the programs I help oversee, where we work with small business owners and really measure the quality and quantity of the business, the jobs that they are creating in the communities that they are based in. And we use a lot of that research and impact assessment to help inform policy decisions. And last but not least, the program that recently joined the PCV portfolio is the Radiant Data Hub, again, a program that I help oversee. And the Radiant Data Hub operates with a mission to help augment the data and AI capabilities of peer CDFIs. So not only does my team do work within PCV, we also work with a handful of CDFIs across the country.
Great, thank you. We can start with the first interesting question. Is AI actually changing how CDFIs lend to small businesses, or are we mostly talking about it at conferences? Sachi, let's start with you.
So I am here to say that yes, in fact, CDFIs are using AI. And it has gone far beyond just something we are talking about at conferences. When we work with CDFIs, we don't want to start with AI and tools. We always ask, what is your biggest pain point? What is the thing that keeps you up at night? What is the thing that frustrates you the most about your job? And that's where we think AI can help make a difference. And so very quickly, there's two use cases that we have seen happening a lot, especially over the last year. Number one, CDFIs and especially underwriting teams are deploying AI agents to help parse through all the documentation that is coming in from their applicants and incoming borrowers. And these agents are helping scrape the most useful information from, say, financial statements and other reports. Because I think we can all agree that underwriters' time spent just copying and pasting data from one document to another is not the best use of time. And then secondly, we are also working with several CDFIs to deploy predictive underwriting models that are trained on that CDFI's historical data to help really surface what are some of the factors that correlate with repayment success. I'll just say one more really quick thing, because anytime I talk about AI, I want to remind everyone that I'm working with that AI should never replace human decisions. It should only serve to augment humans, and humans always must remain at the helm.
Perfect, thank you. Your perspective.
Sure, so AI is certainly a useful tool, and that's how CRF views it. Much like what Sachi just described, we want to make sure that our lending is still human-centered. But this past year, as we were selecting a new loan origination system, the ability and use case of AI as part of the loan origination systems, what they had to offer was extremely important to us, because one of the things that we're looking at is how to streamline our processes and improve our efficiencies, which is time from application to closing. So things like the spreading systems and softwares, portfolio analytics, portfolio management tools and resources to help us predict earlier on when there may be some challenges that our small businesses may be facing. We've primarily used technology throughout our lending life cycle when we take in a borrower's application, but how can we be more efficient with the use of that technology? And we believe that AI will be a great resource for us as we continue to improve our processes.
Great, thank you both, very helpful. I see that it's not just the talking, but I believe we do use AI and technology in our work to strengthen our support.
We have to.
Absolutely.
Yeah.
Yes.
Well, this takes me to the next question. And again, we can start this time with you, Alexis. What actually your organization is currently doing that's bringing meaningful difference right now from technology or AI perspective?
Yeah, from a technology perspective, we use our 3 technology platforms, one to support the overall industry. So our Connect platform is a resource for small businesses to be connected to CDFIs when they may have been not able to access capital through a financial institution. We also use our exchange platform from a programmatic perspective to support bringing in lots of information from CDFIs on their lending that they're doing throughout the program. But in terms of our insights tool, one of the ways that we've used that resource, which is actually pulling in bank account information from our borrowers and creating dashboards, we've used that technology to help us, one, with our MyPace Capital product, which is our revenue-based lending product. We're able to confirm revenue using our Insights product because we're pulling in that bank account information. So it's an ability for us to create innovative working capital solutions for our borrowers using technology. And then in addition to that, with our portfolio management team, rather than waiting for our borrowers to have the ability to provide us with the financial information, sometimes it's very time consuming for them to get it to us in a timely manner. We have the ability to use Insights as the borrowers opt in as a vehicle to understand what's happening with their financials and also help them through maybe some times where they're trying to make a decision about growth or they're trying to make a decision about pivoting based on some changes that have occurred in their business model.
Great. So it means you still keep that human touch part there.
Absolutely.
There's automation, but still there's human touch and judgment that's making the decision.
Yeah, I think it's extremely important, and from an industry perspective as CDFIs, the ability for us to understand the story behind the numbers can't be lost. That is what sets us apart, and that's what enables us to provide more capital and resources to those that historically haven't had the resource. It creates the innovation, and that human-centered component of it is very important.
Yeah.
Great. Thank you, Sachi.
Yes, excuse me. So I'll talk about PCV in particular and how we are trying to really incorporate AI into the entire life cycle of the things we do. So I touched a little bit on the predictive modeling for underwriting, and I'm happy to get a little bit more into detail if time permits there. But again, there, we are very clear that the predictive model is built having been trained on PCV's historical data, and it takes in all the underwriter rubric from PCV so that we know that the decisions that it is recommending to the underwriter is really grounded in PCV's mission. So that's one place where we have had several really good cycles and where we're seeing that it's helping accelerate decision-making on the lending team. The second thing, and the second place where AI has helped us tremendously, is it has helped us fast-track all of our analytics internally. We are now beyond the point where I have to sit and manually wrangle an Excel spreadsheet, thank goodness, to come up with our analytics. We have scripts that we have already put together to help create our reports for all of our various stakeholders. And so I've seen like almost an 8 or 10x speed up in our analytics abilities, which is great. And then the third use case, and this might be my personal favorite, is on the very back end of what we're doing when it comes to impact assessment and what effect is all of our work even having in the communities. So we have a proprietary survey tool that is voice-based, where we can collect voice-based feedback from our small business owners and even their workers, and really ask them open-ended questions about how they've been affected by some of our programs.
Great. Well, this is helpful to hear. And yeah, that takes me to this interesting question, and I think it'll all connect with all of us here in this room, is the fear of like AI in underwriting will encode the same biases that locked our borrowers out of mainstream banking in the first place. How do we respond to that?
Yeah, you want us to?
Alexis?
So yes, that is the space that we have to balance and we have to be conscientious about, is whether or not we are relying so heavily on AI. It's informing so much of our decision that we're taking out the part of it that is the secret sauce to the CDFI industry. So it is extremely important for us to balance that out. I think as some of the things that Sachi described, and one of the reasons why we selected the loan origination system is that we are consistently as an industry having to do more with less. So the use of AI, the use of technology enables us to leverage our teams in a different kind of way and provide more resources and capital. It's just about how you utilize that information. And I've always looked at underwriting as more of an art than a science. And when you take away that human element, you lose part of that art in the underwriting of a loan and the decision making. So it can be an amazing vehicle and tool to move more capital and to support more communities, but we really need to be conscientious that we don't step into a space that we were trying to move away from and move under-resourced communities towards having the resources they need.
Yeah. I would 100% underscore everything Alexis said, and even though I consider myself an AI optimist, we have to be very clear-eyed about the bias component, and we have to go into that eyes wide open. And so there are a few ways that we try to mitigate that bias through the work that we do. So first and foremost, as I quickly mentioned before, we train our algorithms on the CDFI specific historical data. We don't take off-the-shelf solutions and hope they'll work. We also, as we're training our models, we put in safeguards and guardrails, I like to call them training wheels, which really mirror the underwriting rubric that CDFI has been using for years, so that the model knows what is permitted and what is not, and really learns how to stay in those bounds. And then thirdly, and I think most importantly, when we have these models output their recommendations, we have to accompany those recommendations with the model's own rationale. So for example, if a model is saying, I think this borrower is 90% likely to repay, okay, why is that? Don't just exist as a black box. Show me and tell me that you're making that decision based on, say, their revenue and their financial history. And so the more transparent these models get, which is more and more possible now, I think the more decision support you have, and you at least know where those decisions are coming from. So as a human, you can choose to go with that decision or override it.
Perfect.
That's so important. You can choose to go with that decision or override it. That's it. That's the piece that has to be part of utilizing AI technology.
I'm a little curious, Sachi, in how often do you think we should take a look at all these algorithms and models and guardrails that we're putting together? Because things evolve. When we do the analysis, things change, circumstances change, and it requires for us as an industry to adapt. Yeah. So if we have models built in, how often do you see that needs to be updated to continue being more aligned with what we do in the industry? Mm-hmm.
I tell people that you need to be prepared to examine these models every 6 months, ideally every 3 months. And sometimes you have to retune your models between 3 to 6 months. And so that's why these aren't just the magic bullet solution, right? You have to be prepared to make that investment of time and resources, and especially work with, say, machine learning engineers and folks in AI that you trust that understand the CDFI space, because then they will be the first to detect if there is any kind of model drift. But I would say 3 to 6 months, probably at minimum.
Great. Well, in the interest of time, I will go to the last question. And what does a CDFI look like in 10 years if it gets technology right? And what does it look like if it doesn't? So, Alexis,
I get to start.
Can we start with you?
A CDFI that does not use technology and does not continue to innovate may become obsolete. Just to be very honest with you, it is the way that our society is moving. So in order to be effective, it has to be integrated into the work that we do. So the not using it would definitely be a real challenge. I think it is an opportunity for a CDFI that does use it to create more solutions and more impact, just in a much more creative way.
Mm-hmm. I would say because I get asked the question quite a bit if I think AI is going to replace humans or take jobs, right? Everyone's asking those questions. And maybe this is the AI optimist in me, but I actually think in 10 years, I'm hoping, that AI has helped CDFIs create jobs. And what I mean by that is, look, everyone in this room knows that there is always going to be a demand for our loan products, the work we do. That is not going away anytime soon.
Correct.
Most of us cannot even grow fast enough to meet the demand that is out there. So AI can help us better meet that demand, and the shape of the work we are doing today will change. So I am hoping that underwriters, as we're starting to see, they're doing less of that grunt work, and what they are doing more of is being out in the community, meeting business owners. They are doing loan origination face-to-face, not just some faceless, applicant that's coming in through a website. And it's relationship-based so much more, because that's the one thing AI can't do. And even for data teams, they are spending less of their time generating analytics and more time saying, what can we learn from the data that's coming in, and spend a lot more time on product refinement, service refinement, and doing a better job. So I actually think the human part of what we do will only get better.
Perfect. Thank you so much, Sachi and Alexis. One thing that stood out to me as a takeaway that I've noted down here is that technology is not about replacing relationship trust in human judgment. It's about finding ways to strengthen them and expand our impact in the communities that we work. So thank you all for joining us. And please join me in thanking Sachi and Alexis. Thank you so much.
Please welcome back to the stage Sindhu, Lakshmanan, and our panelists.
All right. So for our third and final conversation, I'm really pleased to welcome Amanda Blondeau from Northern Initiatives and Ray Penny from Access to Capital for Entrepreneurs, or ACE. So TA is finally getting its moment on the big stage.
Yay.
So when you look at what makes CDFI lending different, technical assistance is often a big part of the story. It's one of the ways we help entrepreneurs navigate challenges, strengthen their businesses, and ultimately position them for long-term success. And so the challenge, though, is that technical assistance is also one of the most challenging parts of the CDFI business model to sustain. It takes staff time, it takes expertise and resources. It can be difficult to fund. It can be difficult to prove the impact of. And so at a time when many CDFIs are really facing pressure to strengthen their operating performance and build more sustainable business models, there's a real tension between the value technical assistance creates and the cost of delivering it. And so I want to focus our conversation today on that tension. And so I'm going to start with, so Ray, both Northern Initiatives and ACE have developed or invested deeply in technical assistance, making it a core part of how you both support entrepreneurs and small businesses. So I think the fundamental question is why? Like, what role does technical assistance play in your organizations, and what value is it creating for the entrepreneurs and communities that you serve?
Well, the why to me is pretty straightforward. There's a need there. These clients come to us underserved. They may not have the resources that are required to make their businesses grow and scale. They may not have the skill set just yet. And so we are very intentional at Access to Capital for Entrepreneurs, or at ACE, to make sure that we provide a framework that they can become engaged immediately. And I'll give an example of that. If a client comes to us, they've made it through the loan process. Our lending team does a wonderful session on getting to know the client, but also as we're transitioning to closing, they make sure that the client knows that there's a resource at the other side of that. And what I mean by that is that within 72 hours of that closing, they're going to be contacted by one of my internal financial advisors in-house that's going to set the tone for client engagement going forward. What that looks like at the closing table also is we carry or put in the document package a survey. I'm really good at making widgets. but I would like to learn more about income statements, or I'd like to learn more about my balance sheet, or I'd like to learn more about how I can do cost or expense reduction. Those are things that are kind of the starter of becoming that trusted advisor and building that relationship that you have with your clients. So our financial advisors internally will contact those folks. We're now working on processes leveraging Salesforce and automation to make sure that we are uploading all of their information from their financial documents. We're studying those prior to engagement, but then also saying, hi, this is Juan, this is Glenn, this is Corinna, and we're ready to engage in a long-term relationship with you. And then that's the small wins, to use a sports analogy, of providing that trusted advisor starting point. You say, hey, you've closed your loans and you said you're having challenges regarding X. We then look to fill the void there by talking to them about the challenges they're currently having. Those are small wins. I liken it to baseball and say singles and doubles. And then eventually what becomes, or how the relationship grows and scales based on the engagement, is that they're going to be calling you for advice. What do I do about this? I have a concern about this. What do I do to continue to grow and to scale, or to recognize that we have a challenge? Our mandate as a financial advisory team is to do a couple things. We want to make sure businesses grow and scale. We want to have insight on their financial statements every single year. And then if there's a risk component, we are, especially in this day and time, we are very, very intentional about making sure that we protect our portfolio health at ACE, but also from a risk mitigation standpoint, we're getting in front of that early. We don't look at a 30-day delinquency any longer as a financial advisory team, as a lending team, as a credit team. We're looking at 10 days. 10 days, the alarm bells, red flags all start to go up, and we're looking to move forward and engage that client to find out what the challenge is. So we've categorized our portfolio. Red is hot. Red is, in a challenging situation. Yellow is moderate. There's some potential risk on the horizon. Green, probably a little less TA, a little more softer touch, maybe invite them to some webinars, those types of things. So we're very intentional about the TA work that we do, because I know for a fact that it helps to mitigate risk, it lowers delinquency rates, and it makes the clients grow and scale at a better rate. And that's what funders want to hear, and that's what impact investors want to hear about our portfolio and our clients.
Amanda?
How do I follow that? Hi, I'm Amanda Blondo. I'm the Chief Operating Officer at Northern Initiatives. We are a CDFI focused on small businesses in Michigan, and we've been around for over 30 years. I've been with the organization for 22 years and have been a TA coach, have overseen our program, and that has been actually our tagline is money and know-how. The entrepreneurs that we're serving, they are under-resourced. Not only is it capital, but it's the hands-on support as well to help them through. Many of the entrepreneurs we're working with, they have an idea, they're really good at something, but there's all these other pieces around running a business that they maybe haven't had to deal with in the past. So we work with them to be able to support them through the life of the loan. And not only is this a requirement as a CDFI, but also, as Ray had said, we really do see this as an important risk management and a mission builder, because we're looking to create jobs and we want to revitalize our communities. And I think it takes capital, but it takes more than capital as well.
Yeah, and I think what I hear from both of you is that it's core to our mission and how we achieve our impact, and how you build trust in communities, but also how we serve as lenders, right? And we get paid to pay back successfully. So TA, and it's always been the hardest thing to fund, one of the hardest things to fund. And so how do you make the case for it in a way that funders and partners actually hear, especially when grants are shrinking and many organizations are facing that pressure to strengthen their business models and become more self-sufficient, which I know we all love to hear the word self-sufficiency. And Ray, you started talking about this a little bit, about what funders want to hear, but can you elaborate on that a little bit more?
Absolutely. I think in our mindset is that funders want to hear impact. And I think one of the first things that we can show is that we're tracking data that talks about their financial growth year over year. We're tracking, to Amanda's point, about job creation, what that business is actually going through and what they're doing. And Sindhu, I will also submit to you that we learned some very valuable lessons in 2025 about the reliance on federal funding, about the reliance on philanthropic partners. And so we have to think differently about what that looks like, because if those individuals or entities have mission shift, we want to make sure we're doing things internally that are going to offset that. And what I mean by that is, for instance, We need to look hard at, outside of the SBA grant funding that takes care of our microloan portfolio, we need to look hard at those commercial clients and maybe a fee-for-service model and what that can look like. We think that we provide a top-line service and coaching that if you were to go out onto the market would be very expensive. So if I've got a large loan client that really likes our coaching and all of that, I think they should probably pay for those services. There's some other things that we've considered and implemented since we've, like I said, gone through this very interesting time, and we're still in it, but feeling very optimistic about it, is adding even an administrative fee to the bottom line in the loan closing fees structure that we have. And what that does is, again, it helps mitigate the uncertainties that we have if we're not going to be able to get the funding, or we're not going to have SBA reliance in terms of the timing and all of that. These are just things that we're coming up with as an organization that I think are going to help us in the long term. The last thing I'll add to that, and Harold lifted up People Fund, and we're part of the Veteran Loan Collaborative, and we just launched a collaborative with Gustavo LaSalle and his team and the 14 other CDFIs in that group, where there is a cohort, there is a grant component to that, there's also some capital tied to that, and that's just another way, again, to show impact to the funders that are supporting that work, and two, to get the necessary TA assistance that takes off the staffing constraints that are on my team, because we are having to do more with less. And so those are just the things, and we've got to be creative, we've got to be nimble, we've got to work diligently to figure out ways that we can't do things the way we used to do them. That's out. We know that. And so that's what we're looking to do to solve for. So,
those are, to add on top of that, you're thinking about fees. A lot of times it's what are you making on those loans that we're providing? And we're thinking about how do we scale? Because overall our business model includes technical assistance. That is going to stay around. We want to provide capital and TA. And so as we are doing our modeling over the next 5 years, as we're doing we're doing a lot of different modeling because a lot of things are up and down right now. We're looking at the different scenarios about how do we make sure that we can continue technical assistance. SBA TA used to be a given. ARIS, as they rate you as a CDFI, would actually include that in your self-sufficiency ratio. This is the first time that I had seen that, like, oh, that's not a given. So we're thinking about how do you build our overall model so we're more self-sufficient. We've done some things too where we're working a lot with community foundations. We're doing a lot of fund development. We're not seeing a lot of money coming in, but they're still willing to put, maybe we get a PRI to be able to provide loans, and then we'll get a little operating grant with that. So all of that helps. And another area is just thinking about diversifying revenue. So we have a social enterprise that we've created, and we actually started it first more because I was thinking about how do I create efficiency in our TA program, but then others were thinking the same thing, and so now we license that. And so we're always thinking about, is there other ways that we can continue to diversify our revenue so that we can fund our core model?
Great. Yeah, and I think the key theme here is like partnerships and thinking about earned revenue. Yeah. And I think that's something that a lot of people in the room are thinking about right now. And as we kind of, as you said, like in this moment, we can't do things the way we've always done them. Yeah. And so I think you've all both talked a little bit how you're thinking about scaling your services or thinking about how you do more with less in terms of your resources. And the panel before us was focused on AI and technology and how that's transforming organizations. And so technology in general is changing how we deliver everything. What does scale mean for what does that mean for technical assistance? And what opportunities or risks do you see if we don't evolve in how we deliver it or kind of really leverage technology? I was going to say, start with Amanda, because you all have a platform that you've leveraged.
Yeah, and we started this over 10 years ago. My background is actually in technology, and then I fell into the CDFI industry, and very glad that I did. But I was looking at there's these things that I kept looking through my email to find a template, and then other coaches were using other templates, and I was just thinking, I'm using the same things over and over again. How can I leverage technology to have it in a central location, but still be able to have that relationship with the entrepreneurs? It doesn't replace, but it enhances. And I think that's a lot where we hear around technology. It's like, what are those things that we're doing over and over again? What's maybe not that value add? And focusing our time, I still think we need to be high touch. So I always think about high touch and high tech. But there's things that we can be really leveraging technology to help us with while still being able to have that relationship, because that's really where that key is, and where we're getting paid back where maybe others aren't, and we're being able to work with those entrepreneurs.
That's well said. I think from the technology standpoint, from our viewpoint as well, just to add on to, is really the importance of getting systems that talk to each other. That's a whole thing. And when I first came to ACE 8 years ago, it felt like it was a duct tape and all of that. And so we've been very intentional about making sure that we leverage our technology, that we can be more efficient and more effective by having the various components of whether it be the finance accounting team, our CRM system with Salesforce, all of those various components and pieces of the organization that are able to talk to each other. And then I know that the previous panel was talking to AI, and it just seems to be on every conversation on everyone's lips. We're looking at ways that we can implement that into our process flow as well. And at first, science fiction guy, and I thought they were coming for us. But now I've had a change of heart there, and we're working with some entities where we're going to leverage it into, as I described earlier, we come out of that introductory phase and go right into a conversation with an agent that then provides us with a plan of action that we will spoon feed over a period of time, 3, 6, 12 months. And so that does a couple of things. It gets the client engaged and gives them a definitive point of action or plan of action. It also gives a consistent coaching model, and then it gives us a way to keep the clients engaged throughout the process, because that's the secret sauce. We probably engage about 82 to 85% of our clients when I started tracking it a few years ago on a consistent basis. That could be monthly, biannually, quarterly, but we keep them sticky by providing them with the different pieces of the technology and things like that that are going to keep them engaged, and then show them wins. So that's what we're looking to do to mitigate that. So.
Yeah, I do think that the AI overlord is somewhere coming for us. And so Ray, you actually started talking about this when you talked about how you're tracking your data now. But measurement's important. And so how do you know your technical assistance is actually working? What does success look like in concrete terms for your organization and your borrowers?
So to the point of leveraging our CRM system, that's where we collect the greatest amount of data. We're going to get it up front, of course. We're going to get it at the loan closing in terms of our financials and all of the documents there. And then what we're doing, we have, of course, a requirement, like I'm sure all lenders do, that we want to see financial documents on an annual basis. That is easier said than done, but I think when you have that engagement and kind of continue that throughout the year, that they're more inclined to provide those documents for you. And if they're having challenges, they'll address them up front and kind of go from there. And so, again, wanting to keep it laser focused on data points, who we're serving, the client demographic, what job creation can look like, what their financials look like year over year, good or bad. We need to have a line of sight on what that can look like. And we're finally, I used to joke that our Salesforce system was kind of like an iceberg, and we were like the top third of usage of it in terms of getting it to work. And we're starting to get line of sight on things like I get so excited about this kind of stuff, but I'm looking at, now I can go, okay, January 2024, our delinquency rate was X. And now in 25 it was X, and now in 20, so we're starting to get better at the tools that we have and leveraging them to make sure that we're able to do the things, one, that are going to show impact, and two, that are generally going to help the client. So.
And Amanda, what does that look like at Northern Initiatives?
Concrete is not the word I would typically say with measuring TA and impacts. It's something we're always looking at, and but we kind of look at it in short, mid, and long-term impacts, and we build in, so there's self-assessments that the entrepreneurs that they complete up front, and then they do that regularly. So we're looking at what are the skills that they're building, not just the knowledge, but the skills that they're building over time. And our coaches also, every 6 months, will measure what we're called a business strength score, and the Ekblad group helped us, or we use that tool, and we're able to augment that, where we're looking at their trends in profitability, debt repayment, but also the ability to implement systems and to build their team to be able to support their model. And then, we're still collecting revenue, sales, that's our ultimate goal, but that takes some time to really have the wealth impacts, the community impacts, and then we'll also have third-party evaluation. And we're always looking at our data. We're thinking about how do we measure this even more, and it's something that will continue to evolve, and I'm actually excited on how AI is going to help us dig into that a bit more.
Yeah, that's awesome. So we'll check back in on this.
Yes.
And so our last question, this is our moment, right, technical assistance. So what's one technical assistance model or practice you've seen, whether at your organization or elsewhere, that you wish more CDFIs were adopting, or that you wish that every CDFI in this room was thinking about?
Well, so when we started Initiate, I started talking to people and saying, well, what's your process? And first step, a lot of people are like, well, I meet with people, or we have, these classes. But really, what is that process? And I feel like it needs to include, first, where is that entrepreneur at? Where do they want to go? An action plan that helps them along that path, and are bringing in expert resources, online resources, other things like that that help them move along that path, and then reassessing. So it's really just thinking about, we don't have to make this too complicated, but there needs to be these checkpoints, and there's ways that we actually can scale TA while still tailoring it.
I think all well said, and I agree with every bit of it. I think the only thing I would add to that is intentionality, meaning having a team dedicated to this work. It can't be like some kind of a side dish. TA has got to be intentional in your capital structure, in your organizational structure. It's got to be an important part of what you're doing if you're truly looking to help businesses grow and scale and become better at what they do and to provide the necessary resources. So I think it's having a dedicated team that's set aside to provide that TA, check impacts, do surveys, do the reporting that's necessary. And I think that's, to me, is the secret sauce, is that we had a model prior to coming to ACE where literally the loan officer was responsible for production, for delinquency, and oh, by the way, there's this thing called TA. And guess where that landed in terms of impact? And so I think there has to be some intentionality there. So.
Awesome. Well, thank you both. And I think, please join me in thanking Amanda and Ray for their insights and their experience during their experience. So, and I would say, I think our conversation and many of the conversations that we've had this afternoon reinforce a really important point, that capital is essential, but capital alone is rarely enough. It takes partnerships, it takes technical assistance, it takes trust, it takes a lot of different things that we do as an organization holistically to deliver the impact that we want to. And so the challenge, and I think the opportunity for our industry, is finding ways to fund the work, to deliver it and measure it in ways that are sustainable for both borrowers and lenders. And so if you'd like to continue this conversation specifically, Amanda and Ray and Amanda's colleague Mary will both be facilitating a breakout workshop discussion tomorrow focused on the role in technical assistance in small business lending. So be sure to check out the breakouts tomorrow morning. As we wrap up this plenary, I also want to thank all of our speakers this afternoon for sharing their perspectives and helping us explore the many dimensions of small business lending. In terms of looking ahead, we hope you'll join us for this afternoon's breakout sessions beginning at 2:30 p.m., where you'll find a variety of workshops, deep dives, and peer discussions. Then at 4:15, we'll hope you'll connect with colleagues facing similar opportunities and challenges during our networking sessions organized by Job Function. And then for those participating in the CDFIs in Action Taste of Austin tour this evening, please meet at the registration desk on the second floor. And then last but not least, we encourage you to support some of the incredible local businesses financed by member CDFIs while you're in town. You can access a curated list assembled by our membership team and our local co-hosts in the event app. So thank you all for being here, and enjoy the rest of the forum. Thank you all.